Monday morning, February 16th, 2026. Your alarm goes off. You reach for your phone. Before your feet even touch the floor, you check the futures. Red, everywhere. Last Friday gave you hope. A small green candle, just enough of a bounce to whisper, "It's over, the bottom is in." Analysts were smiling again. Social media turned bullish. You went into the weekend feeling confident. Then Monday hit. 30% of paper wealth gone. Not a healthy pullback, not a normal correction, a liquidation. Before you panic, slow down. What just happened wasn't random, and it wasn't personal. The market doesn't hate you. It doesn't even know you exist. To the system, you're liquidity, an order waiting to be filled. That green candle on Friday? It wasn't strength. It was bait. Low volume, thin order books. Just enough upside to pull traders back in, to encourage leverage, to make people believe the danger had passed. But when you trade on margin, you're borrowing fuel, and fuel explodes fast. Then liquidity dried up. Asian markets were quiet. Major physical buyers were offline for Lunar New Year. With thinner volume, price moves become exaggerated. In thin markets, prices don't gently drift, they gap violently. So the sell programs hit. Support levels broke. Algorithms triggered automatic selling. Margin calls followed. Stop losses cascaded. One forced liquidation triggered the next. A digital domino effect. It felt like silver itself collapsed. But what really exploded was leverage. That's a critical difference. There are always two markets: the leveraged paper market, futures, options, ETFs, and the physical market where real metal changes hands. When leverage unwinds, price overshoots. It doesn't calmly settle at fair value. It crashes through levels because traders are being forced out, not because the metal suddenly lost utility. We've seen this before. In April 2020, West Texas Intermediate futures went negative. The screen said oil was worth minus $37 a barrel. But gas stations didn't pay you to fill your tank. Physical oil didn't become worthless overnight. It was a contract crisis, not a reality crisis. That's what extreme dislocations look like. Now, look at fundamentals. Silver isn't just a ticker symbol. It's used in solar panels, electric vehicles, medical technology, electronics, and AI infrastructure. It has both industrial and monetary demand. That doesn't mean it can't fall 30%. It can. It means price and value are not always synchronized in the short term. During forced liquidations, the market isn't asking, what is silver worth? It's asking, who needs to sell right now? If you bought because price was rising fast and you were chasing momentum, this move hurts, especially if you used leverage. If you own physical metal outright with no debt attached, your ounces didn't disappear. Your screen changed. Your holdings didn't. This is a psychological event as much as a financial one. The market is asking, do you know why you own what you own? If your answer is because it was going up, volatility will shake you out. If your answer is based on long-term supply, demand, and monetary concerns, then volatility is noise, uncomfortable noise, but still noise. Let's also be realistic. A 30% drop is significant. It impacts portfolios. It forces re-evaluation. And sometimes that reset is necessary. Bull markets don't end quietly. They shake people out first. They punish leverage. They test conviction. For US investors especially, we're operating in a world of high debt, persistent deficits, geopolitical tension, and policy uncertainty. Real assets in that environment will not move smoothly. They will swing hard. Volatility does not equal worthlessness. So what now? Turn down the noise. Financial media amplifies fear because fear drives attention. Evaluate your exposure honestly. Are you over-leveraged? Is your position size appropriate for 30% swings? Are you investing or gambling? If leverage forced you out, that's tuition paid to the market. If you structured your position responsibly, this is part of the cycle. Markets transfer wealth from the impatient to the patient, from the overextended to the disciplined. Step back and ask yourself, has the long-term demand story changed in a weekend? Did global supply suddenly double? Did industrial use vanish overnight? Or did liquidity thin out and leverage detonate? The investors who survive cycles aren't the loudest. They aren't the most emotional. They understand structure and risk. If you're trading, manage risk ruthlessly. If you're investing, think in years, not weekends. If you're holding physical metal, remember why you bought it, and above all, stay solvent. Opportunity only matters if you're still standing when the dust settles. Breathe. Volatility is allowed. Fundamentals move slower. Now, the question is simple. Did you panic, or did you understand the difference?